Hello, this is Jeff DeMaso, Director of Research of Advisor Investments, with another Advisor You Can Talk To podcast. Today I have as my guest Rick Winters, who's a portfolio executive at Advisor Investments, as well as a member of our Portfolio Review Committee. Rick has also earned his CFP, CRPC, and AWMA designations, which tells you Rick still loves to learn and is passionate about financial planning. Rick, thanks for joining me. So let's talk a bit about the tax code. I often look at it from the investment side of things, what it means for corporate earnings and future investment and repatriation of cash. But you're talking to individuals and what they're doing with their money day in, day out, and what their long-term plans are. So what are you talking to them about in regards to the new tax code?
Right. It is absolutely the center of conversation because it all came in so quickly at the end of the year. The main thing that we've been talking about with clients is how does it impact them? And I mean, on the front end of it, besides the brackets moving around, there's still 7 individual brackets, whether you're single file or joint. But the big change is the fact that you're getting a massive change in the standard deduction, which is going to be a big player on those things that everybody was always looking for, which is itemized deductions, being able to deduct that interest on the mortgage, being able to get deductions from your charitable giving. That is actually the biggest change. The next thing that you're actually looking at is the personal deduction, which actually has gone away, but they've actually shifted over to a much larger credit for kids. So for those people that actually have children, this is going to be a big play for them.
All right. Well, you mentioned charitable deducting, so let's talk there. Has the new tax bill affected how you think about charitable giving, and is giving to charity really all just about taxes?
Well, with the charitable giving, I mean, one of the biggest things that we always focus on is obviously there's tax play. And that was always something that was motivating at the end of the year, is to figure out how you can maximize your giving to all the various charities that you want to support. Maybe you had a conversation with your accountant or your advisor. They said, yeah, you should probably up your giving. But with this tax law change, there's going from 47 million people who itemized in 2017 or expected to, down to an expected number of like 19 million. So those that were really motivated to give to charity based on tax impact, that may be a major shift for some of these charities. There are strategies that you can try to employ to, still give people a reason tax-wise to give to charity, like, bundling gifts, or, if you usually give $10,000 a year, I know I'm going to a big number here because you got to get there to actually get the deductions worthwhile. But maybe you're doing that every 2 years at $20,000, so you can get to that. But the other things that you're also looking at, there's obviously to each individual a number of different strategies you can employ. But charitable giving is really at the root of it. Your main interest is to give to charity, not to get a tax deduction.
Oh, absolutely. And I guess we should also caveat this by we can't give individual tax advice.
Sure.
But, in terms of, there's still a little bit of a tax benefit in terms of if you think about giving to a donor-advised fund, in terms of you can donate appreciated shares. So maybe you could talk a bit about donor-advised funds. What are the ins and outs and the key points that people should know about?
So donor-advised funds are really, they've been around for a long time. But, for most, it may not be something that you're just generally comfortable or aware of. If you go to Fidelity or Vanguard, they talk about it as their gift fund. But if you look in just kind of, jargon talk, it's donor-advised fund. The benefit there is that if you do need to give larger amounts, you can give in a year, let's say those big numbers I was talking about, 10,000, 15,000, or 20,000 for any number of reasons. You can put it all into this donor-advised fund, which doesn't go right out to the charity. It's something that allows you to, maybe you want to give $100 to support a run that a friend's doing. Or at the end of the year, you like to give a couple $1,000s away to charity, but not ready to give 20,000. So you put it in the donor advised fund, it stays invested. You can let that grow ideally. And if you don't ever really push it out to a charity, you can turn it into a substantial account that can be used for legacy planning, get your family involved. That's where these things actually wind up going as you're working with your advisor to try to make sure you're making smart tax and investment planning decisions.
So, you mentioned planning there. How does that figure into planning for people's future? And also you mentioned bringing family members into the conversation. How do you have those conversations with new family members?
Yeah, so, if you talk to people about charitable giving, it really gets down to the check that they wrote or the church that they belong to or something that they feel strongly about. But one of the things that if you went into a business and they said, yeah, we have no mission statement or vision statement, we just kind of do our thing and, get through the day. Well, the business wouldn't be successful. So if you're really someone that's focused on trying to direct your dollars to a cause or an effort with meaning behind it, you should start off with something as simple as, what's your mission? What's your vision? Can you share that, and can you communicate that with your family and your kids? Because guess what? If you do a good job about it, you may not out-survive your gifting effort. And that money would pass on to a family that would have no idea how to continue that effort that you started. So I think that the idea that you have to go in with a plan, and this doesn't sound a whole lot different than when I'm talking to someone about retirement or just getting started saving. If you don't go in with a plan, you're probably not going to come out with a very good end result.
All right, so that's probably pitfall number one, whether we're talking charitable giving, retirement, or any type of investment strategies. Have a plan.
Trying to get my kids to go to bed on time.
Yeah. Are there any other pitfalls when it comes to charitable giving that people should be aware of?
Yeah, so there's a couple really cool strategies out there, and I actually thought that this one was going to be killed by this most recent bill, is that there's the qualified charitable deduction. If anybody's not familiar with that, but if you're of required distribution age from your IRA at 70 and a half, you're required to take a distribution every year. And now that the standard deduction's all the way up to $24,000 for a couple filing, you're probably, if you find yourself outside that itemization range where you no longer can itemize your deductions. And why is that meaningful in the world of charitable giving? Because if you're already taking a $24,000 itemized deduction and you give an extra couple $100 or $1,000 to charity, and you're not going to get the deduction. But if I'm able to use my required minimum distribution, take that distribution and give it directly from the trustee, the custodian holding your money, and get it right over to that charity, that actually takes that income off my tax return altogether. So that's still a real effective strategy. That's for anyone that's over 70 and a half taking required distributions. You can actually do all the way up to 100,000. So there's even way more tax planning that goes behind that, beyond the charitable giving. But anyway, not to get too lost in that answer, but yeah, that's one of the things I think there's really exciting opportunity within the charitable giving space to take advantage of that.
All right, so not to hype what we do, but it's in your role, you can be a financial quarterback between the client and their accountant to talk about some of these different strategies.
Oh, you can't do it on our own. No way. If you're working with anybody that's really trying to get accomplish things in a very effective, meaningful way, you have to be working with their accountant and their estate attorney, because if I'm doing things on my end and it gets to the accountant's desk and they're like, what are you doing? This doesn't make any sense. Or if it gets to the estate attorney, which I don't call on my own because they bill by the hour, but I'm glad to be on a phone conversation with a client at the time they're already planning on talking to them. The accountants are a little more forgiving when it comes to that billing.
Great. So clearly a lot going on there, very complicated, and involves having a plan and communication. Mm-hmm. Are there any other elements to the new code or the new tax code that you think people should be aware of from a financial planning standpoint?
Yeah, so moving forward, obviously living in a state like Massachusetts or those in California, New York, and otherwise, one of the things that I know I was paying close attention to was the mortgage deduction. You can obviously take a mortgage out up to $750,000 and still deduct the interest. That is definitely something that helps when someone's considering that month-to-month mortgage payment that they have to make. How much am I going to of that interest I'm paying? Am I going to be able to actually deduct from my tax return? The other is that just make sure that you are working with someone that has a better understanding of the new tax law. I know I've read a number of 80-page documents trying to give me the full details of these reports or of the various changes, and I'm still learning every day. So I love it when a client asks me a question and I get to answer, I don't know, because that means I get to go and figure out what the answer is. And you want to hear that from your advisor occasionally, because there is no way that everybody knows the answers to all these questions right on the tip of their tongue when that question's being answered. Sometimes I do, but I do like it when I have to go back and look stuff up.
Yeah, no, the markets are, humbling place as well. On the investment side, we try and say, I don't know as well. We don't know what the market's going to do tomorrow. Complicated strategies don't always have an easy answer.
You just want to get in there with your best foot forward. Make sure you're standing on your toes and not your heels. So when the next situation that pops itself up, you're ready to deal with it.
Great.
Oh, and I should also point out the fact that one of the major changes had to do with what the acronym that's being used is SALT, which is state and local taxes. The big issue with this change is that if you're in a high income tax state like Massachusetts, New York, California, New Jersey, you are generating quite a bit of state income tax just off your paycheck. So the new limit now is you can no longer deduct more than $10,000 worth of state and local taxes. Now, that's okay if it's just from your tax, I guess from your paycheck for most people, but this also includes your property taxes. And in these states that I just mentioned, and many others, so I don't want to exclude anybody that's going to be impacted by this tax law change. Not being able to deduct that property tax just made that school system cost a little bit more than some of the other things that you'd been paying for and being able to take as a deduction on your tax return. So Jeff, I would definitely point that out, and I probably should have mentioned that even earlier, but glad we didn't miss it.
All right, this is Jeff DeMaso, and I want to thank you for listening to another of our Advisor You Can Talk To podcasts. I've been speaking with Rick Winters. If you enjoyed this conversation, please subscribe or check us out at advisoryoucantalktopodcast.com. Your feedback is always welcomed, and if you have any questions or topics you'd like us to explore, please email us at info@advisorinvestments.com. Thank you.